So without further ado, I'd like to invite up to the stage a gentleman by the name of Brendan Wallace, who is a serial entrepreneur and is the founder, or co-founder, I should say, of Fifth Wall, talk about digital transformation and collaboration, I think, is a bit of this as well. So well done, Brendan. Thanks so much. Yeah, I think it's just about to go on. We've got the most energetic sound guy in Dan. So Dan, you're going to be running today.
Is this? There we go. So thank you for having me. This is an amazing event. I'm completely overwhelmed by how large the PropTech community is here. So it's really exciting to be here. I'm going to try 20 minutes. I'm going to try and cover a few things in that time. Just quickly who we are and what our approach is. Adding, I think, some of the stats and some metrics to what James just talked about, because I absolutely agree with the thesis that this is an ecosystem and it touches on many different aspects of PropTech can connect to connectivity tech and construction tech and transportation tech in really meaningful ways. And then give some examples of at least how Fifth Wall looks at the opportunity in what we define as kind of built world technology. So basically, this is a reiteration of everything James just said. I think we are in a golden age right now of real estate technology, and what we define kind of broadly as built world technology. But just kind of some of the obvious stats of how big an opportunity this is. A lot of these are US-centric, but I think apply to the UK as well. Real estate is the largest industry in the US. It's 13% of the US economy. It's the largest asset class. It's the largest lending category. And just empirically, it is one of the least technologized industries. So real estate spends about 0.5% on IT, which in comparison to pretty much every major industry in the US is very, very little. And so you really don't have to believe a lot other than to believe that the real estate industry, representing 13% of the US economy, just needs to spend slightly more to become, frankly, one of the largest categories of venture and venture investment. Again, I'm quoting some of the inaccurate stats that James just referenced. But what I think is actually really interesting is now if you look at scale. So this is the number of unicorns created over time in and around real estate technology. And you obviously see a trend here. Companies are starting to get very, very large in the category. And that was frankly the opportunity that we saw at Fifth Wall. We saw this combination of large real estate corporates looking to innovation in growth and kind of mid-stage companies and wanting to collaborate with them and simply not having a vehicle to do so, to articulate those investments. We also saw this dynamic where large real estate corporates were getting it wrong. There was kind of two approaches, I think, in the real estate industry. There was one, the DIY model, which is you had a cottage industry emerge of large real estate corporates trying to invest in early stage tech companies. But as you can imagine, it's very hard to look at a cash flowing real estate asset one day and then an IP driven, cash flow negative dynamic startup the next. The other approach that real estate firms took was to stick their head in the sand. And I think everyone saw the effects of this when you just look at the hospitality industry. So the hospitality industry has really been disrupted aggressively twice. The first was the OTAs, which the hotels were very, very slow to react to. And when they did react in creating a company called Roomkey in the US, it was kind of a categorical failure. And over time, the OTAs have become more and more powerful and taken more share from the hospitality industry. On the other side of that is short-term rentals, which for a while the hotel industry denied was having a meaningful impact on their industry. And today, Airbnb is a larger company than pretty much all of the major hospitality brands out there without owning a single asset. And so when we saw this, the approach we took is, can we drive collaboration? Can we drive collaboration between these large real estate incumbents that are looking to innovate? And can we articulate that innovation through an investment strategy? And can we structure partnerships to help support the growth of real estate technology companies? So that was really why we created Fifth Wall. And I'm going to skip talking through us in detail. But our basic model is about half our capital, $212 million is our first fund. half of our capital comes from some of the largest real estate owners and operators in the US. So Lennar, largest home builder, Prologis, largest industrial REIT, Equity Residential, CBRE, Hines, Host, and Macerich are kind of the core anchor LPs that we work with. And the approach we take is kind of a unique one, where we've combined what I would call strategic advisory services. So what that means is a large part of our business is actually serving as like a McKinsey or an Accenture to these large real estate organizations, helping them think through pain points and opportunities where technology can solve a particular problem for them, doing competitive analyses, doing research, oftentimes hosting RFPs, where we'll literally run an RFP on behalf of our large real estate corporates, select a company that they want to partner with, and then a venture fund to invest in that company. So we're kind of this hybrid organization where we both advise large real estate corporates, but then we invest in the very companies that real estate corporates. I want to talk, this is kind of a cross-section of our portfolio, but since this is the residential stage, and I think I only have 10 more minutes, I wanted to give some examples of how specifically Fifth Wall looks to drive innovation for early stage technology companies by creating these partnerships with our corporate LPs. So, the first example I'll give. So there's a company in the US called Opendoor. Opendoor you can conceptualize as like CarMax for homes. It's a programmatic buyer of US single-family homes. So they have automatic valuation models that are data-driven. So if you're in certain zip codes, typically track home zip codes in the US, so homes that are nearly identical, built around the same vintage, what they'll do is they'll give you a quote on your home. They'll come up with an imputed price on your home within about a minute of you inputting your address. And they'll say, here's what we think the price of your home is. They apply a discount to it, typically around 7 to 8%, and they say, we'll buy your home tomorrow, all cash, no contingencies, at a discount, at a slight discount. So the value proposition to the customer is I can sell my home very quickly. On average today in the US, it takes about 140 days to sell a home, and you typically pay brokers on either end of that trade. So it ends up being about 6% is lost in brokerage commissions. So the comparison is sell a home in 2 days for an 8% discount to fair market value, or sell through the traditional brokerage channels at around 6%. Lennar is the largest home builder in the US. They deliver about 45,000 homes across the US, typically in southern markets and coastal states. They also happen to have a mortgage company, a title insurance company, a home insurance company, and a big specialty finance arm. So when you look at these two businesses, they look about as opposite kind of as you could imagine. You have a data-driven, programmatic buyer of single-family homes. Then you have a home builder, which is in the business of building homes with wood and nails and roofing materials. And what we saw was an opportunity for collaboration, because what Opendoor wanted was volume. They wanted to be able to acquire more homes from guaranteed sources of inventory. What Lennar wants as a home builder is they want to retain customers. So if you buy a 3-bedroom house from Lennar, when you upgrade, you have an extra kid and you want a larger house, they want to retain that customer and keep you in the same neighborhood and sell you a 4-bedroom house. So we're able to structure something called the trade-up program, which now is live on the Lennar website and live in about 3 markets across the US. And what that trade-up program does is it says if you buy a home in a Lennar neighborhood, a 3-bedroom house, for example, and you want to get a bigger house, you basically have an embedded put right on your home to Opendoor, which they actually subsidize. So there's a guaranteed right to sell your home very, very quickly at a very low discount as long as you buy another home in a Lennar neighborhood. So it's a really interesting example of collaboration, because what Lennar gets is they get to retain their customers. They get to keep customers buying Lennar homes over the life cycle as they escalate the houses that they're living in. And what Opendoor gets is guaranteed volume. The other interesting thing was when you're controlling either end of a home sale transaction, that's one of the best points to deliver all these services you have to buy when you buy a home in the US. Title insurance, a mortgage, home insurance. And Lennar happens to have captive businesses that do that. So additionally, it became a funnel to sell all these services as well. And the other interesting thing was that Lennar had a financing arm that was in the business of financing real estate risk. They took on risk positions, credit positions, and all different kinds of US real estate. Opendoor is a startup funded by venture dollars, including ours, so their capital is quite expensive. And so the last part of the partnership was we put together a mezzanine financing line where Lennar puts up, or Opendoor puts up very little capital now when they acquire these homes because they have debt lenders that can actually help them accelerate that. So obviously quite a complex partnership, and I think it's the kind of example we look to show because it shows where you can identify a large corporate and frankly a disruptive company in their space and early on find those opportunities for synergy. So these companies are not in competition with each other, they're actually helping one another. But structuring that and putting that together is quite a bit of work. The next company that I think is interesting is a company called Lyric. Lyric is a hospitality brand within the short-term rental economy. So you can kind of think of them as like a Marriott or a Starwood. And what they'll do is they'll take 10 contiguous multifamily units and they will manage them like a hotel. So they will actually change the sheets, they'll do the yield management and market them, they'll provide the guest ingress and egress and access control, they'll provide some services around that. And the reason it was a really interesting opportunity for us is that multifamily owners in the US saw that many, many residents were renting their homes out on Airbnb illegally. And there is a spread in US markets between short-term rentals, what you can rent a home for on a short-term basis on Airbnb and HomeAway, and long-term rentals, a 12-month lease that typically most multifamily tenants are signing. And there was concerns over security and control. And actually, if you could have a short-term rental unit in a multifamily building, it could be an amenity for the residents of that building. So if they had a guest or their parents come, they could actually stay in that unit. So Lyric was a company. They had very, very few units when we first met with them. We said, look, this is a really exciting platform that we think large multifamily owners will want to partner with. And they're going to want to identify one partner to deploy across the portfolio. So we have Hines, which is a major developer of multifamily units, Invesco as well, Lennar Multifamily, and actually Host Hotels, which has some longer-term stay hotels. And we structured a partnership between them and Lyric, where now Lyric will take units in a Hines building on a guaranteed basis, and they will run them like a hotel inside a multifamily building. So the benefit to the multifamily owner is they're able to capture that upside of what's happening in the sharing economy. And the benefit to Lyric is guaranteed inventory. But again, another kind of partnership that we actually structured here to help accelerate the growth of Lyric and provide a service and a benefit to an early stage company. I'm actually going to go to one more, and then I'm probably going to run out of time. But this is, I think, another really interesting business, more around disruption than anything else. So States Title is a title insurance company. I actually not familiar with the title insurance industry in the UK, but the title insurance industry in the US is basically legalized fraud. You get to sell an insurance contract on something you already know doesn't need to be insured. So you check to make sure that someone appropriately owns their home. Then you sell them an insurance policy that they actually own their home. And you need to get this every time you get a house and every time you get a mortgage. So imagine you have a house, you have a mortgage on that house, and you want to get a new mortgage. You have to get a brand new title insurance policy to prove that you own the home. To show you also how borderline fraudulent this industry is, of the premiums collected in the US, of title insurance premiums, 4% are paid out in losses. So basically, you're just giving money away to title insurance companies. Where does all that money go? So all the money in the title insurance industry goes to sales and marketing to pay for baseball games and boondoggles for the mortgage brokers that they sell through. And number two, to people actually checking the title, checking the actual, that you have a claim to your house. So we invested very early on in a company called States Title. which is doing what all insurance does. They actuarially underwrite. So they don't check the title. They use predictive data models. They predict what an expected loss rate is, how likely there is to be a claim that someone else owns your home, or how likely there's an outstanding lien on your home. And they give you a policy very, very cheaply, very, very quickly, and instantly. So this is an incredibly powerful tool. And as you can imagine, a home builder like Lennar is looking for solutions to make it easier and more digitally native in acquiring a home. They want to provide mortgages and home insurance and title insurance in a digital fashion. It's the same way you're closing a mortgage. You don't have to leave that process and go get a title insurance policy in an analog way. And we're right now in the process of structuring a big partnership between them. But again, this is an instance where you have a very, very disruptive technology that depends in large part on distribution, and we were able to structure a pretty powerful partnership there. I'll give one last one, which I think is super interesting and super quick, and might leave more questions than answers on this one. But Built Robotics, I don't know if anyone's familiar with this company. They're a robotics excavation company. So, which is a complicated way of basically saying it's a Roomba, like a Roomba vacuum, that digs. So it just digs out a trench. It works 24 hours a day. It's unmanned. You geofence where you want it to dig. You tell it how big a trench you want it to dig. And you effectively excavate a home site. And you can move these units from home site to home site. Very, very powerful technology. Lennar, the largest home builder in the US, we're able to structure a partnership now where they're deploying this on a number of home pads across Southern California. So again, a robotics company. As you can see by the cross-section of these companies, and we've done 25 investments, we've structured, I think, close to 60 partnerships across Fifth Wall between large real estate corporates and our portfolio companies. Exactly as James said, this is an ecosystem. This wouldn't probably really strike you as real estate technology, a robotics company or a title insurance company. We've invested in a bike sharing company that intuitively don't seem like they're real estate technology, but they're companies for which real estate distribution and partnerships can be deterministic. And that's really our philosophy and our approach to how we invest. But I think that's probably all the time that I have. So I'm going to turn it back over to James.